I'd like to share with you today some of the things that I've found that prevented people from buying investment properties. I started my own property investing journey 10 years ago when I actually bought my first property in Melbourne. However, I did spend a year researching before I actually bought that property. So I spent a year going to courses and attending seminars and actually reading a lot of books to find out that I was doing the right thing. Fast forward 5 years, I have an investment property business where I educate people through step-by-step property success, and I speak to thousands of investors about why they're investing in property and what their strategies are. I've found that for those that say they haven't invested in property, there's a number of reasons. One might be their partner doesn't want to invest in property. One might mean they don't earn enough money. One might be that they've done it before and it hasn't worked, or they're trying to pick the market and they don't know when to jump in. All of these things actually manifest itself as a fear of getting it wrong. So what I'd like to share with you today is 5 simple strategies on how to get it right and minimize your fears so that you can act when you want to. First and foremost, you need to understand what your goals are. These are your long-term goals, where you want to be, and how much you need to retire on so that you're comfortable. Only then can we look at property investing as a strategy, because when we understand what you want to achieve, we can understand what strategy will allow you to achieve that and in what time frame you need to achieve that. So number 1, look at your goals. Number 2, then assess the property investing strategy. This might be positive gearing, it might be negative gearing, it could be buy and flip, buying off the plan, buying land and developing, it could be subdividing. But it's important to actually make sure that your property investing strategy actually links into the goals that you've set. Thirdly, please understand, property investing is difficult. That's why there's less than 1% of Australians who own more than 3 investment properties. It does take time and effort. Dov says that you have to look at 100 properties before you buy one. And I'm talking physically walk through, not on the internet at night time. My experience has been consistent with this. Of all the properties that I've bought, it has always taken a long period of time to actually find the property that I want. Now, I might see 100 properties. I could put in offers on 12 and have 4 accepted, but eventually it's only one that actually I end up buying. In my experience, if you do the thorough research and understand the techniques in low-risk property investing, you can actually spend 2 to 3 months in actually finding the right property. And once you've set it up, it's a set and forget. The 4th strategy is actually understanding what your exit strategy is. Not just your long-term exit strategy, i.e. that's consistent with your goals, maybe selling off half your investment property portfolio and living off the rent or passing it on to your children, but also your emergency exit strategy. Until you actually build up a bit of buffer of cash, it's difficult to have this as a cash exit strategy, which means if something goes wrong, you lose your job or for family circumstances, that you do need to actually consider selling the property. With a buffer of cash, you can sell it on your terms when it's appropriate in the market for you to sell, not as a fire sale. However, until you have that buffer of cash, maybe you could actually consider some emergency exit strategies as to minimizing your risk of being left with a property that no one else wants. So consider median properties in median areas. Understand what the median looks like in the area that you're looking at and what the median cost property is actually like. There's a reason why banks actually make you put in more of a deposit for 1-bedroom units that are less than 50 square metres, holiday units, student accommodation, and that's because they see it as a risk. If they have to get rid of it, they may not be able to get the price that they want. So you should consider your investment strategies and what you're actually looking at buying along those lines as well. Finally, minimise risk. As an explosives engineer for 15 years, every decision I made was what was the risk, what was the consequence if something went wrong, and how could I minimise that risk. I still use that criteria today. It's important for me to understand what risks can be. It might be something as simple as, what if my tenant leaves in the mid-lease, hence landlord's insurance. It might be something more advanced, such as if I'm doing a development, what happens if the building company falls over. If you understand what the risks are, then you can plan and minimise for them. So, my simple strategies on how to minimise the risk and get some action into property investing. I hope you've enjoyed this talk. I look forward to speaking to you soon, and you can check out my details on step-by-step propertysuccess.com.au.